We have a project right now that was a 2-bedroom, 1-bath house on a multifamily zone lot in a beach community in San Diego, less than a half mile from the beach. Now, there have been 0 new apartments put online in that neighborhood for like the past 4 or 5 years. There's no vacant lots. So we're now taking that 2-bedroom, 1-bath house and we're adding 12 units to it. So it's going to be a 13-unit apartment complex.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is Shawn DiMartile. He's co-founder of Takeoff Capital. Got into real estate investing by liquidating his 401k to partner on a 32-unit in Indiana. In 2 years, he had 3x the value and sold for a substantial profit. He syndicated 150-unit multifamily property in 2001. Then 2 months later, syndicated another 145 units. I always wanted to invest in San Diego, but the low cap rates and landlord-tenant laws made it difficult, of course, as we've all heard about and would expect to make that happen. However, something changed 2 years ago in San Diego, and you're going to hear him talking about it. Man, we dove into this, and maybe it's an amazing opportunity. It sounds really good, but it's something I loved his willingness to be able to, dive in there and see this loophole or see this thing where he could go take advantage of this new opportunity in a market where it seems not many, at least on the show, are seeming to be focused, right? You're going to hear about that today and why he is focused in a market that, like I said, most are not. He even tells you a tech stack towards the end that I thought was very helpful. I've heard of a number of these things, or maybe almost all of them, but I bet you haven't, and I know you're going to learn a lot from Shawn today. Shawn, welcome to the show. I know you have a unique strategy for the market that you're investing in that I honestly don't ever hear hardly anything about. So I'm looking forward to this conversation and learning more from you and why you're excited about this specific market. Before we do that, give the listeners a little more about who you are and your path to syndicating these deals.
Absolutely. So I'll give you guys the 30,000-foot view, a short form of my story. I grew up in Kentucky and, moved out to California after joining the Navy. I served 5 years as an air traffic controller in the Navy, got out and got hired by the FAA right here in San Diego as an air traffic controller. Did that for another 6 years, almost 7. As I was working as an air traffic controller, working long hours, doing lots of overtime, 6-day work weeks, I felt like I had reached my dream job and I was made. And I just started to think to myself, like, wow, I really don't want to grind this hard my entire life. I don't want to be working the mandatory overtime. I don't want to be working weekends. And I started to also have excess cash that I can invest. Eventually, a good friend of mine about 5 years ago introduced me to the Bigger Pockets podcast and said, hey, man, you should think about investing in real estate. And one day on a long drive, I popped on that podcast and started hearing all of these stories of everyday investors and school teachers, et cetera, that built up these real estate portfolios and were able to quit their jobs. And that just resonated with me. It really clicked. I got hooked, listened to every Bigger Pockets episode, started listening to other podcasts, reading books, and essentially just becoming a student of real estate investing. My first ever venture into real estate investing was with a couple fellow air traffic controllers and a few other guys we had met here in San Diego. We joint ventured on a 32-unit apartment complex. That was my very first real estate acquisition before I even bought my own home. And I liquidated my 401k in order to contribute to this deal and get involved. And flash forward a couple of years, we added a bunch of value, sold that property, made a substantial profit. And then we wanted to start scaling, raising money from investors. And we got ourselves a really great one-on-one mentor, a guy that has over 8,000 apartment units, has been doing the business for over 20 years. Shortly after that, he co-sponsored our first 2 syndications, 2 150-unit complexes in Greensboro, North Carolina. And really after that, we were off to the races. We doubled down on this business, went all in. I quit my W-2 job as an air traffic controller last year in March, actually. And today we have a little over 300 multifamily units with those 2 150 units. We sold the first apartment complex, the 32 unit. We acquired a boutique hotel on the coast of California. And now we have a 13 unit project here in San Diego And we're going to get into that whole business model. But that's really the short background of what got me to where I am today.
That's awesome. I love the just the action you took and numerous things there that you did. But to dive into a couple of things, you started educating yourself like mad. It sounded like, right? You started learning, you started listening to all the podcasts. But then you also hired a mentor. Give me the 30-second to a minute on how you picked your mentor. I get the question all the time.
Yeah, and I get it too, because people, secure mentors for so many different ways. And for us, we had started our own podcast right at about the time we acquired that first 32 units. And it was a real estate podcast. We were getting all these guests on the show, learning from them. And so my mentor is actually two brothers. And we had one of them on the show. And we were telling them about how, how hungry we were, how we want to start syndicating, and how a lot of the mentorship programs out there weren't attractive to us because they would have like a lot of students in the course. Your time with the top mentor that you want is limited to an hour a month or an hour every other week or something like that.
Yeah.
And while a lot of people are successful with that, that just wasn't attractive to us. So we were explaining to our now mentor, and he said, hey, we don't really do mentees, but we really like you guys. And after a couple weeks of discussion, they agreed to become our one-on-one mentors, and they still are to this day. They have been for years now. So for us, how we acquired them, I think a lot of it had to do with the fact of everything we were doing up to that point, how hungry we were, the success we had already had, and we just meshed well with those guys. And I think that at the end of the day, that played into it, because these guys don't need to have mentees. Like, the money doesn't matter to them. I really feel like they just were happy to, kind of give back and hold our hands and help us grow.
Yeah, no, I appreciate that. And one thing you said there, I wanted to highlight before we move on, is that these people this mentor didn't have a mentoring program that you actually reached out and asked if they would mentor you. And that's incredible. I love that. You all clicked, you'd interviewed them, and then they agreed to mentor you. And I like too that I almost like it even better that it wasn't like their gig to mentor, right? Or have a mentoring program, and that they're more so in the real estate business, right? Than the mentoring business, right? And a couple quick things. I've shared this years ago on the podcast when I was looking for a mentor many years ago, and I've got many more mentors now for lots of things. But specifically, when I was looking for one, it was like I wanted somebody that was in the business, right? They're actually doing deals now. There's people that were successful 10 years ago, right? And then they just started mentoring, right? I wanted somebody that, and that's not that they're very knowledgeable, right? Of course, they're very experienced, but personally, I wanted somebody that was in the business now. And you hit the other nail on the head. I wanted somebody that I could speak to directly. And there's plenty of people who have had success in other mentoring programs, and that works for many. But for myself, I wanted to be able to talk to that person, right? Often and work with them. And so that was important to me as well. I appreciate you mentioning that. Let's dive into your market a little bit and why. And so, the Navy moved you to California. Sounds like, you kind of started building some roots there, but what market are you in? And let's dive into why you're investing there.
Glad you brought that up. So, I want to address what everyone's thinking of themselves, because it's the exact same thing I thought about investing in California. Most people will tell you that, and myself included, that I wasn't interested in value add multifamily in San Diego for several reasons. Number one, how low the cap rates were, how expensive it is to buy in. You're typically not going to cash flow very well for the first couple of years with the multifamily value add. Landlord tenant laws are really strict here. So if somebody's living in a unit, I buy a multifamily property and I say, all right, we want to not renew their leases so we can renovate those units. Well, that's not so easy to do here in California. If you're taking over and inheriting tenants, oftentimes these tenants can just sit around and say, no, I'm not moving. And the state gives them rights to do that if they've been living there over a year. So it's really difficult to underwrite and plan for, okay, this is how many units we think we can renovate each month or each year for that, because of those laws. And you combine that with the fact that you're buying these, the typical multifamily out here was built in like the 50s and 60s, aside from all the brand new ones. And so you're buying an old asset that you're going to have to put a lot of money into. And it just, for all those reasons, I just said, screw that. We're going to invest out of state. So all of our investing has been out of state. Now, Then San Diego 2 years ago changed their municipal code to allow for bonus ADUs. So I'll explain why they did that real quick and to provide some context. So San Diego is growing, and its job growth has outpaced the national average for years. It's a huge biotech hub, the third largest in the nation. Loads and loads. I think last I checked, 40% of all job openings that required a PhD were in biotech or bioengineering, and something like 20-something% for all bachelor's degrees or new jobs. And then it's also the highest concentration of military assets on the planet. So you have a lot of jobs here and high paying jobs, but the city of San Diego is geographically constrained. It can't physically grow outward. You've got the Pacific Ocean to the west, Mexico to the south, Rocky Mountainous terrain to the east, and a military base to the north blocking it. So all of the flat buildable land's been built on. So what San Diego did, and really the state of California, is they introduced the accessory dwelling units, otherwise known as ADUs. And essentially this just means if you have a single family home or even a multifamily home, you can add, 1 to 2 accessory dwelling units to the property. And these are literally apartment units. So you could take a single family home and turn it into a triplex, and it acts and operates just like one, gets lended on just like one, et cetera. So they essentially are increasing the density where existing housing and zoning laws exist. But San Diego took that a step further, and they said, our problem is so bad here that not only are we going to let you do ADUs, but in certain zones, we're going to allow you to do an unlimited number of these ADUs up to the floor area ratio. So what this means is you can take a single family home that's on a single family lot, or, depending on what zone it is, if it's multifamily, you get even more density. And you can build 10, 20, in some cases, 30 apartment units on that lot in markets and submarkets within San Diego where you otherwise can't build new apartments. So as an example, we have a project right now that was a 2-bedroom, 1-bath house on a multifamily zone lot in a beach community in San Diego, less than a half mile from the beach. Now, there have been 0 new apartments put online in that neighborhood for like the past 4 or 5 years. There's no vacant lots. So we're now taking that 2-bedroom, 1-bath house and we're adding 12 units to it. So it's going to be a 13-unit apartment complex. And I don't want to talk too long because I'm sure there's a lot to unpack there, and I could tell you all these different things we're doing that makes this strategy great and mitigate risk. But that's the gist of this strategy. Is we're now putting on new product online in a really great beach community, and we're able to build these units for a fraction of the cost we can sell them on a per unit basis.
So you said a 13, I may have missed some details there. I was trying to take some notes, but you said 13 unit multifamily built where a 2-bed, 1-bath was?
That's correct.
Wow. Give us some details about the units. Is that all 1-beds? Is that like, how big units are those?
So the 2-bedroom, 1-bath house is going to stay the same. Other than so it's a 2-bedroom, 1-bath house that has an extra room above the garage, and it's a 2-car garage. So the 2-bedroom, 1-bath house will remain. We actually renovated it, and right now it has an Airbnb permit and is being Airbnb'd. And then the 2-car garage is being converted to a 1-bedroom unit. The spare extra room above the garage is being turned into a studio. And then we're building 10 units via a 3-story structure, basically in the backyard.
Wow. Okay.
And those are going to be studios on the 1st and 2nd floor and 2 bedrooms on the top floor. You
said you all plan to sell this once it's all built?
So we're going to build it, lease it up, get it on some, hopefully some good assumable perm debt potentially, and then sell it.
So your goal is not to be ultimate landlord there long term.
So, we're going to do some projects where they are longer holds and some that are shorter holds. So this, this first project over there in Ocean Beach, and we did partner with a guy that's done a lot of these projects, but that first one, we really wanted to kind of introduce our investors to it and start getting the track record of these deals being flipped for a couple of reasons. Like a lot of our investors aren't interested in the 7, or, maybe even 5 to 10 year hold periods, but a lot of them are. So we're going to be providing our investors with opportunities for longer term holds where these can cash flow and continue appreciating. And then some of them are going to be, quicker turns where we can recoup that capital and redeploy it really quickly.
Is this something, is there a lot of competition for that right now? Or is this like a brand new thing? Or
this is a relatively brand new thing. It's about 2 years old. And there's competition, but there's very little competition for a lot of reasons. A lot of people just aren't aware of this strategy. A lot of the bigger buyers, especially obviously institutional buyers, have no interest in these smaller assets. A lot of the larger apartment syndicators aren't interested in assets this small. So it's a niche where we're able to get into this segment of the market, build these units, not have to compete against larger operators for these large multifamilies. We're able to outdo most of the single family buyers. In essence, no, there's not a ton of competition.
You're going to pay. I mean, I guess you'd be willing to pay more for that single family, that 2-bedroom, 1-bath, right? Than somebody that was going to buy it to just live there, single occupant anyway, or family, and still do great.
Exactly. And, for the gist of this, like we're able to build each of these units for around $150,000 to $200,000 on the high end per unit. And these will sell for north of $400,000 per unit. And I've even seen some recently that were like, I think it was a 20 unit ADU complex that sold at $600,000 per unit. And going back to what I said earlier, like this makes more sense to me than buying a 1960s asset for, $400,000 per door and then putting in another, $10,000 per door plus in order to bring it up to market rents.
Yeah.
So honestly, my favorite thing about this business model, though, by far, is that we have an existing structure there that we can rent out while we're waiting for permits. Anybody that's paid attention to multifamily development, invested themselves or anything, knows that one of the most difficult aspects of that is waiting on the government to give you permits to start building. And while you're waiting, you're typically burning through cash because you don't have anything producing income. Now, with this strategy, like I told you, we were able to secure an Airbnb permit because it's a house. So it's actually cash flowing right now while we wait for the building permits, which is something you just don't get usually with multifamily construction. And you're eliminating the holding costs, eliminating one of the biggest risks.
Yeah, no, I like that. I like the cash flow for sure. And any investor would, right?
Yeah,
no doubt about it. Speak to that permitting process. I'm guessing that it's a bear.
It is. And especially because this city is short staffed and their permitting department, et cetera. And anytime you're waiting on the government to get some documents or permits, like they're just not going to hit their timelines. I can pretty much 100% guarantee that. So that is, the biggest pain for this business model is you're waiting for the government. Now, typically your building permits are going to take about a year to get. So you're, just sitting there with the existing property for about 12 months. Then, it could be anywhere from 6 months plus, depending on how many units you're building to build it. And you could usually lease these up in a month or two because the demand is so high and vacancy so low. But in general, yeah, like there's that waiting period of the permit process. The good news is like you're gonna get the permits because of the way the municipal code is written. It's just a matter of the waiting game and pleasing the government and making sure everything is squared away.
So what's the biggest risks in this type of deal there with this specific business plan?
The biggest risk with this specific business plan is just always going to be really the construction phase. Whenever you're doing development, construction is always going to be your biggest risk. Now, there's a lot of ways to mitigate that risk, but once they start digging, they can find things, for example, that are going to cost money to change up. So getting a lot of soil samples is important because there's a vein of a vein of clay soil that goes through like certain neighborhoods of San Diego. So doing your due diligence is hyper important. Because like, let's say you did find that clay vein, you have to remove all of that like clay down to a certain depth and then fill it with dirt. And it's not, you can imagine that that's not cheap to do. So you want to ensure that like your due diligence is, you hyper focus on that, ensuring that, you're looking at historical stuff, environmental stuff, making sure that none of that's going to get in the way. But I would say the biggest risk is the construction phase and the contractors, because at the end of the day, the more you're relying on contractors to renovate and build stuff, the more important they are. Because I mean, like everything falls on their shoulders to make sure that it's built and it's built right so that you don't build it and then it was a crappy contractor and now you're repairing stuff and working with them on, fulfilling their warranty because they didn't install the air conditioning properly and things. So, for us, we're mitigating that risk by, we brought on a general partner that has done over $100 million in commercial construction. Matter of fact, he literally was the project manager and built the building I live in. So we brought on a project manager with his entire life. He's got a master's degree in engineering and project management and has been doing this. So I think that if this is a business model you want to participate in and be an active investor and do this yourself, then my biggest recommendation is you have to focus on ensuring if you don't have that experience and knowledge, you've got to have somebody on your team that does, because that is just a massive part of this business model.
It sounds like even for the passive investor, I mean, they'd want to know, hey, who's managing this project, or who's managing the GCs, right? Yeah, and the
Absolutely.
contractors. Yeah, no doubt about it. I was going to ask you, any other thoughts on advice for the passive investor into this specific kind of business plan?
Yeah, I would say, if you are a passive investor and you're like, analyzing a deal like this, you're interested in getting into something like this, there's a couple things to remember. First of all, number one, if your number one goal with your investments is cash flow, then this might not be the business model for you to jump into, because the first couple of years you're not getting cash flow because it has to get built, obviously.
Right.
So you have to get your permits, you got to build it, you got to lease it up, you got to stabilize it. Now that's going to take about 2 to 3 years. Now, granted, if you're not trying to live off cash flow, that isn't your most important thing, you're just worried about, the greatest average annual return you can get over a period of time, then this is the business model that you might be attracted to. Because yes, we're not going to be cash flowing while we wait to get this all up and running. But once it is and we sell it, not only will it cash flow well, there's opportunities to return most of your capital with refinancing. And if you sell it, you get a pretty great check. I mean, we're talking about a lot of the deals we underwrite hitting 15 to 20% average annual returns plus. So the returns are there. It can be very profitable, very juicy. But, it's different from, the days that we've seen in the past 5 years of being able to acquire a value add multifamily, cash flow 8% plus after renovations. It is different. So that's important to remember. But anytime you're evaluating sponsors on this deal, you want to make sure they have their multifamily experience. Somebody's on the team that has a lot of experience with construction, and that they have, that they have a good relationship with the contractors that are going to be doing the work. Because at the end of the day, that's what's most important.
Yeah, I think it's very wise. It's setting those expectations up front with your investors, right? And I mean, we have preached that inside of our team so many times. It's like when we're starting to do a deal, and we got to set that expectation, especially for something like you're talking about, right? We've had so many projects where they are cash flowing from day one, right? Or within the first 30 days, we can send out some kind of distribution. But then we start to do some kind of development, and some of those same investors, right? It's a just different expectation, or different business plan. And I think we would have been a lot further ahead by. I felt like we made it clear, but we didn't make it clear enough. Looking back, we should have made it more clear. Hey, there's not going to be distributions for 12 months or whatever it may be, or they're going to be a lot less, than that value add deal you invested in 6 months ago with us, So no, I appreciate that, Shawn, and just making it very clear, right?
Yeah, exactly. I think that transparency is going to go a long way, because, at the end of the day, if an investor is like, no, I really I'm going to go get Airbnbs or something, because really all I'm concerned with is primarily cash flow and keeping that coming in. I would just want to tell them then, like, hey, this probably isn't the right one for you. Like, you're going to get a great average annual return, like I said, once we exit and whatnot. Having investors that don't realize that from the get-go are upset, I'd rather they just didn't participate if that was the case, because you want to make sure for sure that your vision, that your investor's vision is aligned with yours, so that you can keep them happy and, perform the way that they're anticipating.
Shawn, shifting gears just a little bit, what's your best source for meeting new investors right now?
My best source for meeting new investors has been educating and giving out free content in multiple different ways. I do everything I can. So I put out content on Instagram every day. I write blog articles and release them every week. I do speaking engagements at real estate meetups and presentations on what we do. I go on as many podcasts as I can possibly get onto. And really, for anyone listening out there, that's the best return on investment you're going to get, because first of all, it's free outside of maybe buying a nice microphone. But like my goal when I started was get on 100 podcasts. Because if each of those podcasts, 1,000 people hears me speak, which would be low numbers, I'm sure way more than 1,000 will hear this. But if you get on 100 podcasts, 1,000 people each, that's 100,000 people that just heard you speak. So doing what you can to do the cheap and free stuff to market yourself so people hear what you're doing, and the people that are interested in what you're doing might want to invest with you. All of that is me casting my wide net out there. And then after that, it's just, really nurturing those leads and having systems, email sequences, more free stuff that I give them to keep them engaged with me is really important too. But where I'm getting most of my investors is from giving out the free stuff, like the ebook.
Yeah. Awesome. Yeah, I appreciate elaborating on the free stuff too. Like it's a great place to start, right? Make sure you're doing those things. What are some of the most important metrics that you track? Could be personally or professionally, something in the business that's important to you or something personally, either one.
I'll do a couple. One of the number one things that really helped me with my business is tracking my personal time. So like, for example, I use an app called Toggle, Toggl. And like what you would call it is basically do a time audit for yourself. So I hyper detail my Google Calendar with events, obviously, but I also put like my to-do list on there as a task so that because I'm constantly checking the Google Calendar. If there's a task on there that I don't complete, it carries on to the next day and I have to mark it as complete. And this lets me more easily remember, oh, I still need to do that. I still need to track this because as you're growing your business, you have so many things that need to get done that if you're not writing it down, then you're just trying to remember in your head. So you're swirling around, oh yeah, I got to get this done. I got to get this done. I want to make sure I don't forget. And it starts to just stress you out. So writing everything down and then using the app Toggle, which combines with Google Calendar. And I hit a button to start the task and then I hit stop when I'm done. And that then tracks all that data of how long things are taking me. And that makes it easier to segment my day because I know how long something's going to take. And it also is like a psychological thing to where I now know like, hey, I don't really feel like doing this, but every time it takes me only 5 minutes to get done. Like I just do it. So that's really helped me. And I use a lot of tech in my business. I use Notion for making, new tasks for my VAs. And it sends them email reminders on tasks and due dates. And I could put a checklist attached to the task I'm giving them. I use Active Campaign to help with my email marketing. So I use Zapier to do a lot of automation. I use Miro, Miro, Miro.com, which is great for creating workflows and processes within the business. So I have a whole stack of different things I use within my business and personally to hyper organize everything so that I don't have to think about it as much. That's really the biggest thing for me because it reduces stress.
Love that. I've heard of most of those. I've never used Toggle before. Does that integrate with Google Calendar?
It does. And it's great because it's just so easy. You just click, record, and then you click stop record, and it, segments it with the task and keeps all the data for you. So that's a huge one. Hunter Thompson recommended that one to me. I think it'll be eye-opening for anybody that tries it to see where your time is really going.
No doubt about it. No doubt. And then Notion, I've heard more and more people talking about using Notion lately. And I've played with it a little bit, but not like committed to learning how to use it best,
To be honest, it's not super user friendly. The interface I'm not a huge fan of, but what it accomplishes is really great.
Yeah, that's awesome. That's awesome. What about any habits that you have, Shawn, that you are disciplined about that have produced a high return for you?
The number one habit that I put in, it's kind of similar to what I just spoke about, but Sunday evenings, I like to look at my week ahead and I like to, start filling it with tasks that I haven't filled it with yet. Make sure that I'm really organized. I know what's coming up for the week. And then, throughout the week, the habit of, waking up in the morning at 8 a.m., I start my day with those tasks and keeping up, adding tasks throughout the week, et cetera. So segmenting my week, segmenting my day as much as possible. That's a habit that freed my mind to where I don't have to think about everything and I can just hyper focus on one thing. The other habit that I have is when I'm working on something, I set aside time for it and then I block everything else out. So my phone's on do not disturb. I close out my emails and stuff. So if another email comes in, I'm not all of a sudden popping over to try and answer it as fast as possible. And then that just broke my focus. So if I'm like, for example, focusing on underwriting a deal or something, that's the one thing I'm doing, and I'm not doing anything else. I'm not looking at anything else. So that I think is going to help a lot of people because it's so easy to get distracted.
Yeah. No, yeah. We live in a distraction focused world, right?
Yeah.
To say the least. I think that's a great tip. It takes a lot of self-control, right, to do that. To prepare your phone or your email or your browser or whatever in a way that, man, you can focus like that. Love that. What about how do you like to give back?
The way I've been giving back, like up until now, it has been mostly just, helping out other investors that are like me when they started out. I give my time, away a lot to people I've met at real estate meetups that, want help and to ask questions and kind of like, a momentary mentor in a way. So I like to give back by just giving out free content, free information on how to do stuff. Usually people will charge you, a lot of money for their program to show you behind the curtain. And I've just been giving that out for free. So I remember being in people's shoes when they got started with no money, wanting to build that big portfolio and not knowing where to go. So I have a special place in my heart for all those entrepreneurs out there, and I enjoy helping them.
Awesome. Well, I appreciate you giving back in that way, Shawn. Appreciate you giving back to us today and really going through how you got to where you're at today. But I want to thank you again for your service, in the Navy, and grateful for that, all our servicemen and women. And then also, just your path, like I said, to getting to where you are, but this new business plan, really, right? This ADUs or accessory dwelling units, this plan, how you can build some more units and make this property so much more valuable than it was, right? Or than it would have been with just that single family unit. And I've not heard of that before. So congratulations to you for going and like figuring that out and then taking action on it as well. Love that when it's like everybody's running from this area, it sounds anyway, right? From San Diego or, but you're figuring out a way to make it happen there. And sounds very interesting, by the way. Even love the tips, the tech tips that you provided as
Thank
well. Shawn, how can the listeners get in touch with you and learn more about you?
So the number one thing I'd like you to do if you're listening is to follow me on Instagram, because that's basically a landing page where you can get all sorts of my free content. And also there's a link in my bio to where you can access my website. You'll get updates on my blog, all that kind of stuff. You can find me at Shawn_DiMartile. Maybe you guys can put that in the show notes or something, because I'm sure no one's going to spell that right. The first name, though, I'll spell it out anyways. It's SHAWN_DIMARTILE. And you can also find me on my website, investorshawn.com, SHAWN.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.